For years, the metals market has been viewed as one of the most stable corners of global finance. Gold and silver sit quietly in vaults. Contracts trade hands in predictable rhythms. Prices move, but usually within understood boundaries. It is not a space associated with sudden disappearance. And yet, in a matter of days, nearly $7 trillion in paper value tied to metals markets was wiped away, not burned in a visible crash, not erased by a single headline. It vanished through repricing, through liquidity gaps, through the silent mechanics of modern financial plumbing. To most people, nothing seemed to happen. Grocery stores stayed open, ATMs worked, the stock market headlines focused elsewhere, but beneath the surface, inside futures, exchanges, derivatives, books, and bank balance sheets, something shifted. The numbers did not explode. They thinned, spreads widened, buyers stepped back, margin calls moved faster than usual. And that is what makes this different. When a tech stock falls 30%, it feels dramatic. When a housing market cools, it unfolds slowly and visibly. But when trillions evaporate in a market that underpins collateral systems, funding channels, and sovereign reserves, the impact is not loud, it is structural. Because gold and silver are not just commodities, they are collateral. They are balance sheet assets held by central banks. They are hedges against currency risk. They sit behind derivatives, contracts, and sovereign reserves. In times of uncertainty, they are treated as neutral anchors, assets without counterparty risk. That reputation is precisely why they matter. So when value disappears here, it is not just a price story, it is a confidence story. In modern finance, most assets are connected through chains of leverage. A futures contract supports a bank's exposure. That bank supports lending. That lending supports economic activity. When the underlying asset fluctuates within normal ranges, the chain holds. But when volatility accelerates and liquidity thins, pressure travels quickly. The $7 trillion figure represents more than mark-to-market losses. It reflects how much exposure was layered on top of a relatively small base of physical metal. Paper claims on gold and silver vastly exceed the amount of metal that can actually be delivered. This structure works until participants begin to question it. And that question is starting to surface. If metals are supposed to be the stable anchor, why are they behaving like beta assets? Why are spreads between physical and paper markets widening? Why are liquidity providers stepping back at the same time volatility increases? These are not emotional questions. They are structural ones, because in every financial system, there is a foundation layer. In the United States and much of the world, that foundation rests on trust in collateral and trust in currency. Metals sit quietly at the intersection of both. They are not the entire system, but they reinforce it. If trillions can evaporate in this layer without a visible crash, it suggests something deeper. The system is repricing risk in real time. Repricing is not the same as collapse. It is adjustment. It is the market recalculating what is solid and what is not. But recalculations of this size rarely happen in isolation. They tend to signal that other assumptions are being reassessed as well. The real issue is not that value disappeared. The real issue is why it disappeared so quickly in a market built on stability. Because when an anchor starts to drift, even slightly, it forces a larger question. If the foundation of value is shifting, what else in the system is quietly shifting with it? To answer that, we need to look at what changed, not just in price, but in the rules themselves. To understand what is shifting, we have to look at the mechanics. Markets run on rules, not written laws alone, but patterns participants come to trust. Gold and silver typically move in response to inflation expectations, currency strength, real interest rates, and geopolitical tension. Liquidity is usually deep. Spreads between buyers and sellers remain tight. Futures prices and physical prices rarely drift far apart for long. Recently, those patterns have weakened. Price swings have become sharper and less predictable. Moves that once took weeks are now unfolding in days. Intraday reversals are larger. Volatility spikes are appearing without clear in isolation. Volatility is not unusual. But volatility combined with thinning liquidity is different. It suggests fewer participants are willing to stand in the middle and absorb risk. At the same time, the spread between paper contracts and physical metal has widened in unusual ways. Futures prices have diverged from spot markets. Delivery premiums have increased in certain regions. Refiners report bottlenecks even while futures markets imply adequate supply. When the link between financial claims and physical inventory stretches, it introduces friction into price discovery. Price discovery depends on confidence that contracts represent something real and accessible. If traders begin to doubt deliverability, they adjust behavior. Some demand higher premiums. Others reduce exposure. Market makers widen spreads to protect themselves. Liquidity fades quietly at first, then more visibly. Derivatives exposure adds another layer. The notional value of gold and silver derivatives far exceeds the value of underlying physical supply. This structure is not inherently unstable. It allows hedging, leverage, and efficient capital use. But it depends on orderly settlement and predictable volatility. When volatility accelerates, margin requirements increase. When margin requirements increase, leveraged participants must raise cash. Raising cash often means selling what is liquid. In that environment, even assets considered safe can be sold to meet short-term funding needs. That is when safe havens begin to behave less like anchors and more like risk assets. The pattern becomes self-reinforcing. Volatility triggers margin calls. Margin calls trigger sales. Sales increase volatility. Another quiet shift has appeared in interbank funding markets. While not yet in crisis territory, short-term borrowing costs have shown signs of tension. Banks rely on collateral quality to secure funding. If the value of commonly pledged assets becomes unstable, lenders apply more caution. Haircuts rise, terms shorten, flexibility declines. These are subtle signals. None alone indicates systemic failure. But together, they suggest strain. History offers context. In the late 1960s, stress in the London gold pool signaled cracks in the Bretton Woods system before the dollar was formally detached from gold. In 2008, unusual behavior in precious metals coincided with broader funding stress that later erupted into a global banking crisis. In the European sovereign debt episode, spikes in gold aligned with rising doubts about government balance sheets. Metals do not cause these crises, they reflect them. When safe haven assets behave erratically, it often means participants are hedging against something deeper. They may not articulate it directly, but their positioning reveals concern about currency, stability, sovereign debt, sustainability, or bank counterparty risk. That is why the $7 trillion figure matters. It is not simply a valuation adjustment. It represents the scale of exposure built on the assumption that metals markets would remain stable and liquid under stress. When that assumption weakens, participants recalibrate, risk models adjust, funding lines tighten, confidence becomes more selective. Markets rarely send clear messages. They send distortions, unusual spreads, volatility spikes, liquidity pockets that vanish at critical moments. These are not dramatic headlines. They are structural whispers. And when multiple whispers begin to align, experienced participants pay attention. Because when traditional rules, stable hedging behavior, reliable price discovery, deep liquidity begin to bend, it often signals pressure building elsewhere in the system. The metals market may be flashing that signal now, but to fully understand it, we have to move beyond financial contracts and look at the physical world underneath the mines, the refineries, the shipping lanes, and the geopolitical leverage that ultimately determine who controls real supply. To see what is really happening, we have to step outside the trading screens and into the physical world. Every futures contract, every options structure, every hedge ultimately points back to something tangible, metal that must be mined, refined, transported, stored, and verified. The paper ecosystem moves at digital speed. The physical ecosystem moves at geological speed. Gold and silver do not appear because demand spikes. They are extracted from, or bodies that took millions of years to form. Mining projects require years of exploration, permitting, financing, and construction. Even once operational output grows slowly, grades decline over time, energy costs fluctuate, labor disputes emerge. Environmental regulations tighten. Supply is not elastic. At the same time, refining capacity is concentrated. A significant portion of global precious metal refining passes through a small number of facilities in specific regions. When geopolitical tension rises, or when energy constraints affect production hubs, bottlenecks form quickly. Shipping disruptions can delay deliveries. Sanctions can redirect flows overnight. This is the layer often ignored during periods of market calm. On paper, metals markets appear deep and liquid. Open interest in futures contracts can represent multiples of annual mine supply. Exchange-traded products allow investors to gain exposure with a click. Banks structure swaps and forwards for clients around the world. But the physical base underneath is much smaller. There are far more financial claims on gold and silver than there are ounces readily available for delivery at any moment. Under normal conditions, this imbalance does not create stress. Most contracts are cash settled or rolled forward. Only a small fraction result in physical delivery. The system works because participants assume deliverability, if required. The moment that assumption is questioned, the structure changes. If industrial users, electronics manufacturers, solar panel producers, medical device firms fear supply disruption, they increase inventory. If sovereign buyers accelerate accumulation to diversify reserves, they remove metal from circulation. If retail investors demand physical bars rather than paper exposure, vault inventories tighten. Each decision is rational in isolation. Collectively, they strain availability. This is where power enters the story. Large banks operate as intermediaries in the paper market. They provide liquidity, structure derivatives, and facilitate hedging. Commodity exchanges set the rules for settlement and margin. Sovereign wealth funds and central banks act with strategic motives, not short-term profit goals. Industrial consumers prioritize supply security over price fluctuations. When stress rises, these actors do not behave the same way. Banks reduce balance sheet risk. Exchanges raise margin requirements. Sovereigns accumulate quietly. Industrial users lock in long-term contracts. Each move shifts leverage. The headlines may focus on daily price changes. Gold up 3%, silver down 4%. But those fluctuations are surface reflections. The deeper contest is about control over physical inventory and access during uncertainty. Consider energy as well. Mining and refining are energy-intensive processes. If oil or natural gas prices spike, production costs rise. If energy infrastructure faces disruption, output slows. In a world already navigating supply chain fragility, metals are not immune. Now combine that with geopolitical concentration. A limited number of countries dominate mine output for certain precious and critical metals. Policy changes, export restrictions, or strategic stockpiling can alter global availability. When trust between major powers declines, resource security becomes part of national strategy. Under these conditions, price becomes secondary to possession. A futures contract promises exposure. A physical bar represents control. As long as confidence remains high, participants treat these as nearly interchangeable. When confidence weakens, the distinction grows sharper. This is the structural imbalance at the heart of the system, a vast digital marketplace layered on top of a slow-moving, finite physical base. The leverage embedded in that structure amplifies both stability and stress. In calm periods, it enhances liquidity. In tense periods, it magnifies competition. And when competition intensifies, pricing signals can distort. Premiums in one region may diverge from benchmarks elsewhere. Delivery times extend. Large buyers negotiate privately rather than through open exchanges. The public market reflects only part of the story. The real battle is not about whether gold trades at one level or another on a given day. It is about who can secure supply when trust thins. Because when collateral becomes strategic, and when physical assets become instruments of leverage, the implications extend beyond commodities. They reach into banking systems, funding markets, and currencies. Which brings us to the next layer of the story: how stress in tangible assets feeds directly into money itself, into the dollar. Global liquidity, and the architecture of the financial system built on top of them. When control over physical supply starts to matter more than quoted price, the issue moves beyond commodities. It moves into money. Modern finance runs on collateral. Banks lend to one another. Institutions borrow short-term to fund longer-term assets. Derivatives are cleared and margined daily. At each step, something must be pledged as security. That something needs to be trusted, liquid, and stable in value. Gold has played that role for centuries. Even in a fiat currency system, it remains a reserve asset on central bank balance sheets. It is one of the few financial instruments without counterparty risk. No promise attached. No earnings forecast required. Just ownership. In the global dollar system, collateral quality is critical. The US dollar is dominant not only because of military or political influence, but because global trade, debt issuance, and interbank funding are largely denominated in dollars. To access that system, institutions must post acceptable collateral. When metals markets function smoothly, gold and silver enhance the perception of stability. They serve as balance sheet buffers. They support confidence in reserves. They diversify sovereign holdings away from pure currency exposure. But if volatility rises sharply and liquidity becomes uneven, collateral assumptions shift. If the market value of pledged assets falls quickly, lenders demand more security. This is known as a higher haircut. A bank that once needed to post $100 million in collateral may now need $120 million to secure the same funding line. That difference must come from somewhere. Often, it comes from selling assets. This is where feedback loops begin. Falling asset values lead to higher margin requirements. Higher margin requirements force asset sales. Asset sales push prices lower. Lower prices raise funding stress. The cycle is mechanical, not emotional. In a dollar-based system, these pressures ripple globally. Emerging markets borrow heavily in dollars. Corporations issue dollar-denominated debt. When funding costs rise in New York or London, the impact is felt in São Paulo, Istanbul, and Jakarta. A stronger dollar, driven by global demand for liquidity, can strain foreign balance sheets. Local currencies weaken. Servicing dollar debt becomes more expensive. Central banks in those countries may raise interest rates to defend their currencies, even if domestic growth is already slowing. Meanwhile, in developed economies, banks facing higher funding costs tighten lending standards. Credit becomes less available for businesses and households. Investment slows, hiring slows, growth decelerates. The connection between metals stress and economic slowdown may seem indirect, but it runs through collateral channels. If gold prices fall sharply under forced selling, central bank reserve values fluctuate. If silver markets seize due to industrial demand and supply constraints, pricing becomes less reliable for hedging. Uncertainty in these markets raises overall risk perception. Risk perception affects capital flows. Capital flows affect currency strength. Currency strength influences inflation, trade balances, and interest rates. This is why the dollar's dominance is not simply a political arrangement. It is collateral-based, as long as global participants trust the assets underpinning the system. Treasuries, high-quality bonds, stable commodities, the dollar remains central. But when multiple collateral categories experience volatility at the same time, stress compounds. Consider the interaction between treasury markets and metals markets. If investors sell treasuries due to rising yields while also selling metals to meet margin calls, liquidity thins in both arenas. Funding markets become cautious. Repo rates fluctuate. Banks hoard cash. Liquidity preference rises. When liquidity preference rises, growth slows. None of this requires a dramatic collapse. It can unfold gradually through tighter standards and smaller risk appetites. But the cumulative effect can be significant. At the same time, some actors respond differently. Sovereign buyers may increase gold accumulation to hedge against dollar risk. This creates a paradox. Private markets may sell under stress, while public institutions buy strategically. The push and pull influences price behavior and currency narratives. If confidence in collateral erodes too far, alternative settlement mechanisms gain attention. Bilateral trade agreements denominated in local currencies expand. Central bank digital currency pilots accelerate. Reserve diversification discussions intensify. These shifts do not happen overnight. They emerge from persistent friction. What begins as volatility in metals markets can evolve into broader questions about funding, reliability, and currency stability. The $7 trillion repricing is not merely a commodity event. It is part of a wider recalibration of risk inside a highly interconnected system. And when that recalibration filters down from sovereign reserves and interbank funding desks, it eventually reaches households and businesses. The next step is to understand how these structural shifts translate into everyday reality, how collateral stress, liquidity tightening, and currency movements affect retirement accounts, borrowing costs, and financial security at a personal level. If systemic stress follows patterns, then the future will likely unfold along one of several recognizable paths, not because markets are predictable, but because financial systems tend to respond in structured ways when pressure builds. The first scenario is stabilization. In this path, central banks step in early and decisively. Liquidity facilities expand. Funding markets receive support. Balance sheet tools are adjusted to prevent disorderly collateral repricing. Margin pressures ease as volatility declines. Spreads between physical and paper markets narrow. Under stabilization, metals recover gradually, not because fear explodes, but because confidence rebuilds. Interbank lending conditions improve. Dollar funding remains accessible globally. Credit growth slows temporarily but does not contract sharply. This scenario requires coordination and credibility. It depends on policymakers acting before stress compounds. It also assumes that underlying balance sheets, both public and private, remain fundamentally solvent. The second scenario is the slow grind. Here, no dramatic crisis emerges, but stress lingers. Lending standards tighten incrementally. Funding costs stay elevated. Liquidity remains selective. Asset markets experience repeated volatility waves without a clear resolution. In a slow grind, metals markets may remain unstable, not collapsing, but not fully normalizing. Physical demand competes with financial positioning. Sovereign reserve managers diversify cautiously. Businesses delay long-term commitments. Economic growth decelerates, not abruptly, but persistently. Confidence erodes in small steps. This scenario can be difficult to recognize in real time because it lacks a defining event. Instead, it is characterized by fatigue, a gradual narrowing of opportunity and risk tolerance. The third scenario is a structural reset. In this path, collateral repricing goes deeper. Funding stress accelerates. Central banks intervene, but their tools face limits. Reserve preferences shift more noticeably. Gold accumulation increases at the sovereign level. Bilateral trade arrangements expand outside traditional dollar channels. The dollar does not disappear, but its dominance is tested more openly. Treasury markets face sustained volatility. Banks reassess cross-border exposures. Financial architecture adapts, potentially reshaping how global liquidity is distributed. A structural reset does not imply collapse. It implies transition. Systems evolve under pressure, but transitions can be uneven and disruptive. Importantly, none of these scenarios are predetermined. The outcome depends on signals that unfold over time. Liquidity spreads in funding markets will reveal stress levels. Central bank balance sheet expansions or contractions will indicate policy stance. Physical delivery data in metals markets will show whether supply constraints are easing or tightening. Interbank borrowing rates will signal trust among institutions. Watching these indicators provides a clearer picture than reacting to daily price swings. It is also possible that elements of each scenario appear simultaneously. Stabilization efforts may coexist with a slow grind in certain sectors. Structural adjustments may occur gradually beneath surface calm. Uncertainty is not a flaw in analysis. It is a feature of complex systems. The goal is not to predict a precise outcome, but to recognize which direction the system is leaning. When collateral markets strain, when liquidity preferences rise, when reserve strategies shift, these are not isolated developments. They are interconnected responses to pressure. We began with a simple observation. $7 trillion in paper value tied to metals markets vanished through repricing. That number alone does not define the future. What matters is what it represents, a recalibration of trust inside the financial system. Metals may be acting as the warning light, but warning lights do not tell us exactly what is wrong. They signal that something deeper requires inspection. If the indicator is flashing, the real question becomes unavoidable. What is happening inside the engine of the banking system itself? And how exposed are sovereign balance sheets if this pressure continues? That is where the next chapter of this story must go. When stress builds inside collateral markets and funding channels, it does not stay confined to trading desks. It filters outward, often quietly, into daily financial life. The first area affected is credit availability. Banks operate on competence and capital. If funding costs rise, or balance sheet assets fluctuate sharply in value, risk managers respond. Lending standards tighten. Credit lines are reviewed more carefully. Margins of safety increase. This does not mean banks stop lending altogether. It means they become selective. For households, that selectivity can appear as higher mortgage rates, stricter approval criteria, or reduced refinancing options. For small businesses, it may mean shorter loan durations or higher collateral requirements. These shifts can slow expansion plans, hiring decisions, and investment. Retirement systems are also connected. Many pension funds and large asset managers use derivatives to hedge interest rate exposure or enhance returns. Those derivatives require collateral. If market volatility increases, margin requirements rise. Funds may need to raise cash quickly. That can mean selling equities, bonds, or other holdings, even if the long-term outlook has not changed. In that environment, portfolio values can fluctuate more than underlying economic conditions alone would suggest. This is where mental models become useful. The first is the collateral chain model. Imagine a series of linked supports. At the base is a tangible asset, perhaps a government bond, perhaps gold. On top of that sits a loan. On top of the loan sits another derivative contract. Each layer depends on the stability of the one beneath it. If the base shifts even slightly, adjustments ripple upward. Understanding this chain helps explain why volatility in one asset class can influence many others. It is not always about fear. It is about structural linkage. The second model is liquidity first. During uncertain periods, institutions and individuals prioritize access to cash. Cash settles obligations. Cash meets margin calls. Cash reduces dependence on short-term funding markets. This preference can drive asset sales even in markets considered safe. When you see simultaneous declines across different asset classes, it is often liquidity preference at work. Participants are not necessarily bearish on everything. They are prioritizing flexibility. Recognizing this pattern helps separate temporary stress from permanent impairment. The third model is paper versus physical. In normal conditions, financial claims and tangible assets trade close to parity. A futures contract represents future delivery. An exchange-traded product represents stored metal. Most investors are comfortable with this abstraction, but in periods of strain, distinctions matter more. Claims depend on counterparties, settlement systems, and liquidity. Physical ownership depends on custody and storage. Each has trade-offs. The key is not to romanticize one over the other, but to understand their differences. Applying this model clarifies why premiums, delivery times, or settlement rules can become focal points during stress. For individuals, the practical takeaway is not to react impulsively, but to observe carefully. Watch lending standards. Monitor funding costs. Notice whether volatility is concentrated or broad-based. These are signals about system health. Economic slowdowns rarely begin with a dramatic headline. They begin with incremental tightening. A loan application takes longer. A refinancing offer disappears. A business delays expansion. By viewing these developments through structured mental models, it becomes easier to interpret events without panic. Systemic stress is complex, but it is not mysterious. It follows patterns shaped by leverage, collateral, and liquidity. And once we understand those patterns, The next logical question emerges. Where does this path lead? Does tightening stabilize the system? Does it grind slowly? Or does it force a deeper structural adjustment? That is where we turn next, to the range of possible outcomes and the signals that will determine which path unfolds.